Welcome to the fourth video in our series on standard costing and variance analysis. In this video, we will be focusing on the various labor variances which we can encounter. Make sure you have mastered the variances we discussed in our third video on materials variances, as you will notice that many of these are similar in principle to our labor variances. So what are our learning objectives for this video? Essentially, they follow the same pattern as our material variance learning objectives. First, we want to be able to identify the different labor variances that we have. We then want to be able to calculate the different variances. And finally, we need to be able to identify potential reasons for these variances. To begin, let us quickly recap our example for the series. We have a company manufacturing widgets, and the standard cost card is presented. For this video, we will be focusing on the direct labor. Notice that we only have one type of direct labor in our example. Again, if we focus on the direct labor, we see that we budgeted 50,000 hours at 10 Rand per hour. Something always to consider is whether or not we are complying with the minimum wage rate. We then see that we actually used 48,500 hours at 12 Rand per hour. Importantly, on this slide, we see that labor was paid for 500 hours during which they performed no work. This was because of an unexpected machine breakdown. Now let's consider the labor variances we can get and how they compare to our material variances. On screen are the material variances we discussed in our last video. Now, what labor variances do we get? First, we get our total labor variance, which is the difference between our flexed budget, which we looked at in video 2 in the series, and our actual labor expense. This variance is based on the same principles as our total materials variance. We then get our labor rate variance, which arises when the actual rate we pay our labor differs from the standard rate. In essence, this variance is the same as our material price variance. Next, we have our labor efficiency variance, which considers how long our labor actually worked compared to how long they should have worked for. This variance follows the same principles as our material usage variance. Our labor rate variance can then be broken down into a pure rate variance and a joint rate efficiency variance. This is particularly relevant for separating the performance of HR from operations. Conceptually, these variances are the same as the pure price and joint price usage variances under materials. Our labor efficiency variance can be split into the idle time and pure labor efficiency variance. These variances differentiate for unplanned idle time, where the workers are just sitting around idle, but still have to be paid. A similar variance could theoretically exist for materials which are damaged in the warehouse because of flooding or some other non-operational reason. Finally, our pure labor efficiency variance can be broken down into a mix and yield element when we have labor of different classes that can be used to perform the same function. This will usually only work in one direction, however, where more skilled labor performs the work of less skilled labor, maybe to meet a deadline. These variances are equivalent to the materials mix and yield variances. In this example, because we have only one class of labor, we will not have a mix and yield variance. Now let's begin with the labor rate variance. Remember, this variance is equivalent to the material price variance. Pause this video and give it a go. See if you can calculate the labor rate variance. Great. So like a price variance, when we determine the rate variance, we need to compare what the labor should have cost to what it actually cost. In this case, we see that it should have cost 10 Rand per hour, but it actually cost 12 Rand per hour. This means that we spent 2 Rand more than we were supposed to. If we spend more, it is unfavorable. So now we know that the labor rate variance is 2 Rand per hour, but we need the variance for all the hours worked. So we need to ask now, should we use the actual or budgeted quantity? We use the actual quantity because that is what we spent the extra R2 on. For labor, we don't need to ask if it is the actual quantity purchased or used. We don't hold stock of labor, so this question, which we asked under materials, is irrelevant. So our labor rate variance is the R2 multiplied by the actual quantity of 48,500 hours to give us an unfavorable variance of 97,000 Rand. Now pause the video again and give the journal entry a try. Let's see what you come up with. Okay, so let's start with buying the raw materials. What is our basic journal entry? We'd want to debit wages control and credit bank. How much should we debit and credit each account with? Let us start with the bank account. Here we simply ask how much leaves our bank account, which is the 48,500 hours multiplied by 12 Rand per hour. Now let's move on to the wages control. Remember, it must be recorded at the standard. So we take the 48,500 hours multiplied by the standard rate of 10 Rand per hour. Now we have a balancing figure, which is our rate variance. Why is it the rate variance? Because it was our rate that varied by 2 Rand per hour, whereas our number of hours has remained constant. Is it favorable or unfavorable? And we see that it is unfavorable as it is an expense on the debit side. Now let's consider the reasons why the rates may have changed. Take a moment to pause this video and see what reasons you can come up with, and then we will go through a few ideas. Okay, great. So let's have a look at a few ideas. Firstly, maybe we didn't account for inflation or other wage rate changes correctly. This could have been due to changes in the minimum wage rates or the outcome of collective bargaining. Maybe we had more qualified or experienced staff than we expected, and we had to pay them more. Alternatively, we may have had capacity constraints and needed to pay our employees overtime. As discussed under the material variances, pay careful attention to the scenario and look for the applicable evidence when coming up with your reasons. Let's move on to the labor efficiency variance. This variance follows the same principles as the materials usage variance. Pause the video and give it a try. Great, so hopefully you have your answer. When we determine an efficiency variance, we need to compare how much labor we should have used to what we actually used. In this case, we see that we should have used 45,000 hours, being the 9,000 widgets produced at 5 hours per widget. We actually used 48,500 hours. This means that we have used 3,500 hours more than we were supposed to. If we use more, it is unfavorable. So we now know that the labor efficiency variance is 3,500 hours, but we need a Rand value. So we need to ask, should we use the actual or standard rate? Because labor is already recorded at the standard rate in the wages control account, we use the standard of 10 Rand per hour. So our total labor efficiency variance is 3,500 hours multiplied by the standard rate of 10 Rand per hour to give us an unfavorable variance of 35,000 Rand. Now let's think this whole thing through in terms of journal entries. We ask, what is our basic journal entry? We debit WIP and we credit the wages control. Let's move on to the amounts and we'll start with the wages control. We ask, how much is leaving our wages control account? It is the 48,500 hours at 10 Rand per hour. How much is going into our WIP and at what rate? Remember, we need to record everything at standard. So we use the standard quantity of 45,000 hours and the standard rate of 10 Rand per hour. The difference is now our efficiency variance. Why? because the rate has stayed the same at 10 Rand, but the efficiency has varied. And again, we see that the efficiency variance is on the debit side, indicating that it is unfavorable. Now let's consider the reasons why the efficiency may be different. Again, take a moment to pause this video and see what reasons you can come up with. And then we'll go through a few ideas together. Okay, great. So first we can look at the quality of various things, such as the materials, our staff, and our machinery. Lower quality would likely make our staff work slower, as they need to be more careful, or there will be more breakage. Lower quality and less experienced staff will also work slower. Maybe there are some relationship factors we need to consider. Staff may be unhappy or demotivated, causing them to work slower. Maybe there are capacity constraints leading to overtime. Staff may work slower during overtime as they are tired. Again, look for evidence in the scenario you are facing and don't just list every possible reason, even if they don't apply. Now let's break down the rate and efficiency variances further. Pause the video and based on your knowledge of the material joint price usage variance, see if you can calculate the labor joint rate efficiency variance. Great, so I hope you have an answer. Let's go through it together. First up, we have the joint rate efficiency variance. Remember that this variance is particularly relevant to staff incentives. In this example, we will see it as extremely relevant as the HR department, who are responsible for the wage rate, may be penalized for the inefficiency of the operational departments through the adverse efficiency variance. Let's see how this works. So from our previous calculations, we saw the total labor rate variance was 97,000 Rand unfavorable. However, some of this unfavorable variance was because production was less efficient by 3,500 hours. The HR department may say that they are not responsible for the wage rate difference on the inefficiency of the production departments. So we can break this variance up. We know that our total labor rate variance was 97,000 Rand unfavorable. Our pure rate variance will exclude any production inefficiencies. So had the production departments been efficient, only 45,000 hours would have been used, being the 9,000 widgets multiplied by 5 Rand per widget. Multiply this by the change in rate and we get an unfavorable variance of 90,000 Rand. We then calculate our joint rate efficiency variance. Again, we take the difference in price of the 2 Rand, but now we multiply it by the 3,500 hours we were inefficient on. This gives us 7,000 Rand unfavorable. So the HR department may be happy to take responsibility for the 90,000 Rand variance, but not the 7,000 Rand variance. Now let's deal with our last variance, the idle time variance. So we know that our total labor efficiency variance was 35,000 Rand, unfavorable. But the scenario also tells us that labor sat around idle for 500 hours due to an unexpected machine breakdown. So we can separate out this idle time variance from the pure efficiency variance. So again, our total efficiency variance was the 35,000 Rand unfavorable. We know that the total inefficiency time was 3,500 hours. But 500 of this related to idle time. So our pure efficiency variance is the total inefficiency of the 3,500 hours less the 500 idle time hours to give us a pure efficiency variance of 30,000 Rand unfavorable. The idle time variance is then simply the idle time of 500 hours multiplied by the standard rate of 10 Rand per hour to give us 5,000 Rand unfavorable. Now let's wrap up this video with a summary of our labor variances. Remember, in our second video in the series, we calculated the overall variances. Based on this, we know that our total labor variance is 132,000 Rand unfavorable. This is made up of our labor rate variance of 97,000 Rand unfavorable and our labor efficiency variance of 35,000 Rand unfavorable. We can further break up our rate variance into the pure rate variance of 90,000 Rand unfavorable and a joint rate efficiency variance of 7,000 Rand unfavorable. Likewise, we can break up our efficiency variance into the idle time variance of 5,000 Rand unfavorable and the pure efficiency variance of 30,000 Rand unfavorable. Notice that we don't break up our efficiency variance into the mix and yield components because we only had one class of labor. That brings us to the end of our video on labor variances. In our next video, we will look at our variable overhead variances, where we will see even more similarities. See you next time.